Hi, this is Richard Flax at MoneyFarm, talking about some of the things that have caught our attention over the past 24 hours. Well, it was the end of a very eventful quarter, where we saw equity markets fall by more than 20%. We saw the price of oil fall by more than 60%, firstly driven by a price war between the Saudis and the Russians, and latterly caused by the significant drop in demand as the global economy to a large extent has closed as a result of the coronavirus. And lastly, we saw significant policy action both from governments and from central banks to try and support the economy, and also to ensure that the financial system is functioning as best it can through lower interest rates, through quantitative easings, through providing liquidity to financial institutions, and by buying back not just government bonds but also corporate bonds. Looking at other events, we see in China the economic data continues to suggest a recovery, admittedly from a very low level. But there are signs that that economy is slowly beginning to normalize. Now, how long that takes and how effective that proves to be is still very much up for debate. But we are seeing signs that the opening that we read about in newspapers is being reflected in economic data. Elsewhere, we've seen a resurgence in infection rates in Japan. And so it raises this question that we've addressed before around, will we see a second round of infection passively later in the year, and what implications might that have? So that's something to keep an eye on. And we've also seen at the corporate level, particularly in the UK, a lot of financial institutions cancel their dividends under guidance from the regulator, and also agree not to try and buy back any equity, and really to make sure that they preserve as much capital as they can so that they can lend into the economy rather than return what might once have been deemed excess cash to shareholders. From an economic perspective, it's probably the right thing to do. From the perspective of keeping those banks as well capitalized as possible, it also makes sense. It will clearly disappoint some investors who were relying on those dividend yields as an anchor of value, as it were. But at the end of the day, that seems to be in this environment the right thing to do from a corporate perspective. So when we think about the environment, it still remains challenged. We think volatility will still be with us for a while longer. But at the end of the day, we see some signs that the trajectory of infections is beginning to follow a pattern. And so it's a pattern we can think about trying to project out. And then think about, well, when will these economies reopen? How long will it take for the recovery really to kick in? And what implications might we see particularly from starting levels of leverage? How much debt is in the system? And this is a little bit of a challenge, and it's a challenge that we see policymakers trying to address to ensure that companies are able to refinance their debt, that there is some support, maybe a lot of support, for both corporates and households in terms of trying to make sure that we can come out of this with an economy that's in a good shape to start a recovery over the next few months. So that's what we've been focused on. Thank you very much for joining us, and look forward to speaking to you again soon.